Paying taxes is a given, but do you know how to manage them strategically? This week, we'll show you how to navigate the tax landscape and keep more of your hard-earned money. Don't miss these essential tips to make tax season work for you on today's Money Minutes. Hi, my name is Mike McMeans, president of Silverling Financial. Welcome to Money Minutes. Most people understand that they have to pay taxes, but not how to strategically manage them. On income, there are federal, state, and local taxes, but there are also payroll, Medicare, and Social Security taxes. Beyond that, when you are considering how to take income from what you have saved, a lot goes into making sure you are using the most appropriate money at the most strategically sound time. The main item I want to cover in this installment is capital gains taxes. Capital gains taxes are the taxes you pay when you make money on something that is not inside of an IRA or some other kind of tax-qualified account. First, let me make clear that the income that you get from something while you own it is taxed as ordinary income as dividends and income. So that part is subject to your marginal tax rate in the year that you earn it. Capital gains taxes, by comparison, are the taxes you pay on a gain when you sell something. They are as follows. In 2024, it's actually a zero capital gains rate if you are single, making up to $47,025, or if you're married, up to $94,050. For single people, from $47,025 up to $518,900, or for married, from $94,050 up to $583,750, the capital gains rate is 15%. And then for single people who make over $518,900, or for married people making over $583,750, it's 20%. Said another way, if you keep your income under a certain level in the same year where you have a very large capital gain, you could end up paying zero in capital gains taxes. In fact, I had a client who paid zero capital gains and saved hundreds of thousands of dollars on a several million-dollar gain, simply by making sure he sold his asset in a year where his income was less than $94,050. The only other way to manage capital gains is through either an exchange into a like product, like from one real estate investment to another, or to die with the asset. You may be thinking, what benefit is there in dying with an asset? Well, that's a great question. You do have to be mindful of the estate tax, which is a whole other conversation. But let's say you have a 100-acre farm. And let's assume that that farm has gone up a lot, like from $1,000 an acre to $15,000 an acre, something that has happened a lot here in Ohio. If you sold it while you were living, the taxes due, assuming you made a married household income of $250,000, would be a 15% tax on the gain, or 15% of $1.4 million, which is $210,000 in tax. Yikes! By comparison, if you decided to pass away with the farm and let your kids sell it, the increase in value is completely wiped away because the federal government looks at it like the kids bought the farm at your death. So they'd owe tax on zero because the value they paid and the value it was would be the same. Strategies like this can save people literally millions of dollars. There are many more complex strategies to consider, strategies we'd be happy to discuss one-on-one. Feel free to leave your comments below, and feel free to follow us on social media or connect with us on our website. I'm Mike McMeans, president of Silverling Financial, and thank you for watching. Speaking of taxes, which superhero pays no taxes? Spider-Man. All his income is net. We'll see you next time.